John Crypto here. Silver just erased almost 50% of its value in a matter of days, and then snapped back 17% in 48 hours like nothing happened. Let me say that again slowly. From an all-time high of $121.64, silver was smashed to sub $70, panic headlines everywhere. And now it's sitting calmly around $81 to $82, as if the market didn't just experience a financial heart attack. Here's the kicker. This is the most violent liquidation in modern silver market history. Not in 2008, not in 2020, not even during the COVID crash. This move was bigger, faster, more surgical, and yet the official story is already being rolled out. They're telling you this was just volatility. They're telling you it was profit-taking. They're telling you it was speculative Chinese traders. That's the lie, that this was random, that this was emotional, that this was just another noisy market move. Because if this was really just speculation, then explain to me how a $1 trillion derivatives market loses half its value in days and recovers 17% in 2 sessions without something snapping inside the system. That doesn't happen in healthy markets. That happens in forced liquidations. This wasn't a rally. This was an extraction event. Here's what actually happened. Silver wasn't selling off. Silver was being liquidated. Over-leveraged paper longs got obliterated. Margin requirements spiked. Stop losses were triggered like landmines across the futures curve. Once the first layer broke, the system did what it always does. It ate itself. Every forced sell created more downside, which triggered more margin calls, which forced more selling, which collapsed open interest, which fed back into more liquidation. A classic cascading failure. Not fear, not emotion, not retail panic. A mechanical kill switch. Now connect the dots. During the crash, futures volume exploded. We're talking about some of the highest volume days ever recorded in silver contracts. But open interest? Open interest collapsed. And that detail changes everything. Because when price falls and volume rises but open interest drops, that means positions aren't being rotated. They're being destroyed. That's not traders choosing to exit. That's traders being forced out. When open interest collapses but price rebounds, that's not fear. That's strong hands absorbing weak hands. That's exactly what happened here. Retail got trapped. They bought calls near $120, convinced silver was going to $150, $200, $300. Then the liquidation hit, and they were flushed out near $70, selling at the exact bottom. Smart money didn't panic. Smart money waited. They watched the bloodbath. They waited for the forced sellers. They let the margin calls do the dirty work, and then they stepped in quietly, buying what retail was vomiting. Now price rebounds 17% in 48 hours, and the same media that told you to buy at $120 is telling you it's just a rebound. It's just technical. It's nothing structural. That's psychological warfare. Because the entire purpose of this move was not to crash silver. It was to reset the leverage. They needed price lower to cleanse the derivatives market. They needed volatility to wipe out speculative positions. They needed fear so retail would dump their exposure. And they needed silence on one thing. The real reason. This liquidation wasn't about speculation. It was about control. When silver runs too fast, the paper system breaks. Futures contracts start to demand physical settlement. Industrial buyers panic. Vault inventories tighten. So the system does what it always does. It engineers a crash. Not because silver is weak, but because silver is dangerous. Dangerous to banks. Dangerous to vaults. Dangerous to a system built on promises instead of metal. This wasn't a market move. This was a pressure release valve. They let the steam out before the boiler exploded. And now they're telling you it's over. Now they're telling you the risk is gone. Now they're telling you stability has returned. But look at the price. After losing half its value, silver is still sitting above $80, not $40, not $30, not back to pre-breakout levels, above $80. That's not weakness. That's structural demand refusing to disappear. That's buyers stepping in even during the worst liquidation in decades. And here's the part that should terrify you. If silver can survive a 50% engineered crash and still hold this level, what happens when there's no paper left to flush? What happens when the next demand wave hits? But there's no more leveraged longs to liquidate, no more retail to scare, no more margin calls to trigger. That's when price doesn't retrace. That's when price disconnects. That's when the paper market loses control. And they know it, which is why this entire episode was designed to make you believe the danger passed, that the crisis is over, that the system is stable again, that silver already had its moment. But the real crime scene was never the chart. The real crime scene is behind locked doors, because if you think this was about speculation, wait until you see what's happening inside the vaults. The real story starts with physical supply. But physical supply, and once you see the inventory numbers, the whole story collapses. Because here's the crime scene. Silver is still sitting 30% below its all-time high, yet industrial demand hasn't slowed at all. In fact, it's accelerating. Electronics, solar panels, EV batteries, military hardware, AI data centers, defense systems. Every single one of these sectors is consuming silver permanently, not storing it, not recycling it, burning it. Unlike gold, silver doesn't just sit in vaults. Silver disappears. Now connect the dots. The two pillars of the global silver market are COMEX and the London vault system. That's where settlement is supposed to happen. That's where paper contracts are supposedly backed by real metal. And those vaults? They've been bleeding metal for years. Every major delivery cycle, registered inventory shrinks. Every spike in demand, eligible inventory gets drained. Every stress event, withdrawals accelerate. The system isn't growing supply, it's losing it. This is the part no one wants to talk about, because the entire silver market is built on a lie of scale. For every 1 ounce of real silver, there are 100 plus ounces of paper claims floating around in futures, options, swaps, ETFs, unallocated accounts. Some estimates put it at 150 to 1, meaning 1 bar of silver is promised to 100 different people. So as long as everyone stays in paper, the illusion works. But when price crashes, physical demand spikes, mints run out of coins, premiums explode, industrial buyers lock supply, wealthy investors ask for delivery, and suddenly the system faces its real enemy, redemption. This is the leverage trap. Banks manufacture synthetic silver using futures contracts. They sell what doesn't exist. They flood the market with phantom supply. This suppresses price artificially. But the moment enough people say, I don't want paper, I want metal, the math breaks, because there isn't enough silver to deliver, not even close. So what do? They engineer volatility. They crash price to flush demand. They force liquidations to kill off delivery requests. They reset leverage before the next settlement window. This isn't theory. This is how the system survives. And the main architects of this game? JP Morgan, COMEX market makers, bullion banks. They don't lose in crashes. They cause crashes. Here's the real play. They smash price. They force margin calls. They liquidate paper longs. They scare retail into selling. Then quietly they accumulate physical. Not through headlines, not through ETFs, not through visible channels, through private deals, off-market transfers, vault-to-vault movements. While you're watching red candles, they're taking delivery. That's the villain's move. The media tells you, speculators caused the crash. Chinese traders caused volatility. Retail got too excited. That's the bait. The switch? Banks caused the crash to protect their own inventory positions. Because if price keeps rising without a reset, delivery pressure builds. And delivery pressure is fatal to a fractional reserve metal system. This exact pattern has happened before. In 2008, gold was suppressed before the largest money printing event in history. In 2020, silver crashed below $12, then quadrupled. In crypto, FTX proved what happens when paper claims exceed real reserves. Same structure, same lie, same ending. The market isn't unstable because of speculators. It's unstable because it's hollow. A system where 100 people own the same ounce cannot survive real demand. It can only survive if people never ask for what they're owed. And that's why this liquidation was so aggressive. It wasn't just about price. It was about buying time. Time to reset leverage. Time to rebuild paper buffers. Time to keep the illusion alive. But here's what they can't control anymore. Global physical demand isn't coming from hedge funds. It's coming from sovereigns, governments, central banks, state-backed buyers. And they don't care about charts. They care about control of supply. The West trades digits. The East takes delivery. The West speculates. The East accumulates. And this is where the story turns dangerous. Because the most critical drain on silver inventory is no longer happening in New York or London. It's happening in Asia, where silver trades at premiums the West can't even match, where buyers pay more, wait longer, and take physical possession, where metal leaves the system permanently. And once it's gone, it never comes back. But the most dangerous part isn't in New York or London. The real action is happening in Asia, where silver is being bought at prices the West can't even see, where silver is being bought at prices the West can't even see, because once you step outside New York and London, the entire narrative flips. Here's the kicker. In Shanghai, physical silver doesn't trade at COMEX prices. It trades at a premium, historically 2 days to $6 higher per ounce than New York. Same metal, same atomic structure, same industrial use, but in Asia it's worth more. That alone tells you everything. If silver were truly overvalued, speculative, or in a bubble, the cheapest place on earth would be where people are actually taking delivery. But it's the opposite. The place where people want real metal is where price is higher, meaning the paper price in the West is artificially cheap. And that gap isn't closing, it's widening. Now connect the dots. China, India, Middle East. These aren't hedge funds. These aren't day traders. These are state-level buyers. Massive imports, long-term contracts, strategic hoarding. They're not buying ETFs. They're not rolling futures. They're not flipping paper. They're locking physical supply for decades. While Western investors argue about charts, Asia is quietly draining the market. This is the great divergence. The West treats silver like a financial instrument. The East treats silver like a strategic resource. And that's why the metal is leaving. Because silver isn't just a shiny rock. Silver is embedded in missile guidance systems, satellite hardware, solar energy grids, EV infrastructure, 5G networks, AI data centers. This is military and economic infrastructure, which brings us to the part no one wants to say out loud. The real buyers aren't retail investors. They're central banks and sovereign funds. But they don't announce it. They don't file press releases. They don't pump headlines. They use intermediaries. They route through private firms. They buy through off-market channels. Why? Because if the public realized how much silver was being absorbed by governments, the paper market would implode overnight. Silver is strategic, not just as money, but as power. Power grids need it. Defense systems need it. Renewable energy needs it. Semiconductor manufacturing needs it. You can't build the future without silver. And here's the part that makes this irreversible. Global mining supply is structurally capped. Mexico and Peru, two of the largest producers, are facing declining ore grades, rising extraction costs, political instability, environmental restrictions. It's getting harder to pull silver out of the ground. And even when they do, most silver isn't mined alone. It's a byproduct of copper, zinc, and lead, meaning production doesn't scale with silver price. Even if silver goes to $200, supply doesn't magically double. The pipeline is fixed, which means every ounce taken off the market today makes the next ounce more expensive tomorrow. Now zoom out. While Asia is accumulating real assets, the West is doing the opposite, printing money, expanding debt, inflating balance sheets, trading derivatives. The West creates digits, the East accumulates atoms. And this isn't an accident. This is a geopolitical strategy, because silver and gold are now being used in bilateral trade settlements. Countries are bypassing the dollar, using metals as neutral collateral, reducing exposure to US debt. BRICS is openly exploring metal-backed systems. Not crypto, not bonds, not fiat, metal. Because metal can't be sanctioned. Metal can't be frozen. Metal can't be printed. Here's the line that should haunt you. If gold is the reserve, silver is the bloodstream. Gold stores value, Silver moves value. It flows through industry. It flows through infrastructure. It flows through global supply chains. And whoever controls that flow controls the future. The East understands this. The West pretends it doesn't matter. One side is building a metal-based system. The other is doubling down on debt. West, $40+ trillion in liabilities, zero real backing, infinite printing. East, hard assets, strategic reserves, physical delivery. The West believes price is reality. The East knows ownership is reality. And that's why this isn't just a silver trade anymore. This is a power shift. The metal is leaving, the control is leaving, the leverage is leaving. Every ounce shipped to Asia is an ounce removed from Western financial dominance. And once that metal is gone, it never comes back. Not into ETFs, not into futures, not into unallocated accounts. It's locked into vaults that don't answer to Wall Street. This is why volatility is increasing. This is why liquidation events are becoming more violent. Because the paper system is fighting a losing battle against physical reality. And that leads to one unavoidable conclusion. Silver isn't just a trade. It's a front run on the collapse of the debt system itself. And once that system cracks, the entire financial world goes with it. The global financial system is sitting on the largest debt bubble in human history. The United States is now over $40 trillion in debt, and that number is accelerating. Interest alone is becoming one of the largest line items in the federal budget. Not military, not healthcare, not infrastructure. Interest. Japan, the canary in the coal mine, is already cracking. Bond yields that were artificially suppressed for decades are finally breaking free. Their central bank owns so much of its own debt that the bond market barely functions as a real market anymore. Globally, debt-to-GDP ratios are at record levels across developed nations. Europe is leveraged. China is leveraged. The US is leveraged. Emerging markets are drowning in dollar-denominated liabilities. The system only works as long as interest rates stay low. But inflation forced rates up, and now the math no longer works. 2. The Fed's printing trap. Central banks are trapped in a two-option prison. Option 1. Raise rates to fight inflation. Result: debt collapses the system. Option 2. Print money to save the system. Result: currency collapses. There is no third option. This isn't theory. This is history. Every major empire eventually chooses printing. Roman Empire debased silver coins. Weimar Germany printed marks. Zimbabwe printed trillions. Venezuela printed bolivars. The script never changes. Only the currency name does. The US will not choose default. It will choose devaluation, because default ends power. Devaluation hides it. 3. The system is broken. Banks are technically insolvent. They survive only because accounting rules allow them to pretend unrealized losses don't exist. Governments are permanently over-leveraged. They cannot pay their obligations without issuing new debt to pay old debt. And fiat money itself is backed by nothing except belief. No gold, no silver, no hard assets, just confidence. And confidence is the most fragile asset in existence. Once it breaks, it never comes back. 4. Why silver explodes. Silver sits at the intersection of three forces. Monetary hedge. When people lose faith in paper, they move to real stores of value. Industrial necessity. Silver is essential for electronics, medical tech, solar panels, EVs, military systems, and energy grids. Geopolitical weapon. In a fragmented world, strategic materials become leverage. Gold is mostly stored. Silver is mostly consumed. Gold can be recycled endlessly. Silver gets burned into products and disappears. That means silver's above-ground supply is shrinking while demand is accelerating. This is the opposite of how commodities usually behave. 5. Price projection. Forget daily candles. Forget resistance lines. Look at structural math. In 1980, silver hit nearly $50. Adjusted for inflation, that's over $150 today. In 2020, silver broke a 40-year compression pattern. Bank of America, one of the most conservative institutions on earth, has publicly modeled triple-digit silver scenarios. When you combine monetary demand, industrial scarcity, geopolitical hoarding, currency debasement, a logical price range emerges: 150-300 dollars per ounce in the next full cycle, not because of speculation, because of necessity. 6. Call to action. This is the part no one in finance wants to say out loud. Not ETFs, not futures, not unallocated accounts, not banks, not brokers. Those are promises, not assets. In a systemic crisis, paper claims compete with each other. Physical metal doesn't compete with anything. It simply exists. Self-custody physical silver means no counterparty risk, no digital gatekeepers, no financial censorship, no default chains. If the system freezes, screens go dark, banks close, or capital controls appear. Only one thing still works: what you already possess. 7. Mic drop, philosophical end. They want you inside apps, inside dashboards, inside digits. They want your wealth to exist only as permission. Silver is weight, silver is mass, silver is reality. You can't print it, you can't fake it, you can't cancel it. And in a world where systems are collapsing, currencies are decaying, and trust is evaporating, what you hold is what you own. If this video made you uncomfortable, it means you're starting to understand what's coming. Don't watch this twice and do nothing.